Hi, welcome. Good afternoon or possibly good morning, depending on where you're listening to us here from today. Great webinar we have today. Great guests. We're going to talk about underwriting private loans. That's an investment that we see a number of individuals do within a self-directed IRA, and I'm sure many people on the call who might be using their IRA to do it also probably do a lot of private loans personally as well. So today's presentation, I'm being hosted by myself. I'm Scott Maurer. I'm the Vice President of Sales here at Advanta IRA. I've been with the company for a number of years. My educational background, I'm a licensed attorney. I don't do any perform any legal work for Advanta clients, but does give me maybe a little bit different understanding of some of the different things that we see and deal with on a day-to-day basis. If you have any questions during the webinar today, I want to make sure you know that there's a question box on the GoToWebinar control panel. You can type your question into that box and make sure either myself or our guest presenter gets that question answered today. If you have any questions though after the webinar, you can always reach out to me. My contact information is here on this slide. I reach out to my phone, email, whatever works best for you. Just a quick disclaimer, the webinars that we provide are for educational purposes only. Today's webinar is, I think, a fantastic example of that. We're not talking about any kind of deals at all. We're talking about really what you need to do as a private lender, what you need to be aware of. But just be aware as well that Advanta IRA does not provide any investment advice, and we do not endorse any products, or say specific products. We certainly endorse the idea of self-directing your account and looking for alternative assets. Ultimately, it's up to you to make sure that you do your due diligence on the investments you're making, which again, is one of the central points of what we're going to talk about during today's webinar. A little bit about our company. If you're unfamiliar with Advanta IRA or maybe new to the company, we're a self-directed IRA administrator. It's the only thing that we do on a day-to-day basis is hold retirement accounts and help people invest in alternative assets. We currently have over $2.5 billion in assets under management. We have over 11,000 active clients as well. We try to set ourselves apart in a couple different ways. One is really the customer service experience with our concierge level of service, and also our learning center. We are really committed to educating, and we do that in a number of ways. We do webinars once or twice a week. We have some online networking events. We speak to private groups. We attend a lot of networking events outside in various areas. And our website as well is a great resource for information regarding self-directed IRAs. If you are listening to this webinar, or possibly listening to this on a recording, if you're not live with us today, you can check out more videos on our video library. And for those of you who are listening live, if you ever miss a webinar or maybe something you want to investigate from the past, just go to our website, click on the YouTube logo, and go to our Advanta On Demand channel. We're going to see a history of all of the recorded webinars that we've done over the last few years. For those of you who are, again, have not heard of self-directed IRAs or possibly new to self-directed IRA accounts, one of the questions we get asked a lot of times is, why haven't I heard about this, or why haven't I heard about this sooner? And the reality is that most retirement accounts, most IRAs, most old 401k accounts are administered by banks and brokerage firms who offer limited investment products. You know, your Schwabs and your Fidelities may be great firms for buying and selling publicly traded securities, but they're not interested in allowing you to invest into alternative assets, like some of the things that we'll talk about today. They only offer you and allow you to invest in what they sell. But IRS regulations allow you to invest in anything that is not considered life insurance or is not considered to be a collectible, like artwork, antiques, things of that nature. So those are the only two prohibited investments you cannot make inside of a self-directed IRA, or really any type of IRA account. So you do have other choices. You have a lot of other opportunities. We'll go over a few of those here in just a moment. But it's important to note what kind of accounts and what kind of monies can be self-directed. So if you're looking at this type of investment strategy, if you have any type of IRA, traditional IRA, a Roth IRA, if you're self-employed and have a SEP or a simple IRA, or maybe even a solo 401k, you can certainly self-direct those monies. It's a matter of just filling out the right paperwork to make that happen, to get the money moved over, get that money transferred, and ultimately placed into the alternative investment that you're looking for. In addition to any type of IRA, any type of old employer's plan, your old 401ks, old 403b plans, old 457s, they can also be self-directed by simply electing to do a direct rollover from your old employer's plan into a new IRA account. The only restriction when it comes to self-directing your retirement account is a current employer's plan. Your current employers can place limits on your ability to move money while you are still employed there. But again, any type of IRA, any type of old 401k can be rolled over, can be moved into a self-directed IRA, where you then have the ability to take advantage of a number of different types of assets. Now, a lot of what we see at Advanta IRA and probably with other custodians as well are real estate based assets. It can be actual real estate like a rental homes, commercial property, rehabs, condos. We've seen a big uptake the last few years in multifamily real estate and syndications. So your IRA can invest in the hard asset, the actual physical property, whether you're looking to receive the rents back in to help grow your account, tax-free or tax-deferred, whether you're looking to flip the property, make a quick profit, whether you want to invest passively, like I said, into some type of REIT or a syndication where somebody else is doing a lot of the work and you're simply providing the capital and receiving payments back each month or each quarter. So certainly individuals use their IRAs to invest in the hard assets, the hard actual real estate, but we have a number of individuals who invest in what we call paper assets. Your IRA providing financing for someone else. Could be for another investor, could be for a homeowner. It could take the form of a mortgage loan where your IRA is lending money, just like a bank would, to somebody who is going to purchase a piece of real estate, and they're going to give your IRA account a mortgage. The collateral that we'll talk about here with our guest presenter in just a moment, the mortgage, real estate can be the collateral for that particular loan, and you can hold that in your IRA. We've seen individuals also invest in tax liens and tax deeds, which are also, again, it's not the actual property. You're investing on liens against a piece of real estate. When it comes to lending inside of an IRA, we certainly see a number of individuals, as I mentioned, doing the mortgage loans where you have that secured collateral, but it is possible and permissible under the IRS rules for you to do loans as unsecured notes, where someone simply provides a promise to pay and signs a note, and that's all there is to that agreement. How comfortable you feel with your borrower and what else is involved in that transaction would determine ultimately probably whether you would go forward with that type of loan. Again, option contracts, assignments, again, joint ventures, accounts receivable, these things all have in common is that you're really investing in the paper, which is going to be the focus again of today's webinar. I think for people who are looking to do either real estate or possibly maybe doing paper assets, might depend on really the type of an investor that you are or that you want to be. Someone who wants to be more active and be more in control and hands-on might tend to invest in rental properties or rehabs where they are making the decisions on the property. They are using, though, more of their time and energy and possibly expenses as well to manage the property, but ultimately the benefits from that investment are going to be pretty much theirs to take in and receive back into the account. Or you have people who want to be more passive, where they can simply provide the capital for another investor or another individual and sit back and receive payments on a monthly or quarterly basis. So passive investments, those do include the private lending options that we're going to talk about today. So when we talk about private lending, there's a lot of different ways you can lend money. Again, there's traditional mortgages, you can do short-term transactional funding. As I mentioned already, you can do unsecured promissory notes, joint venturing. The key thing with lending inside of, if you're talking at least about your IRA account, is the person who is borrowing cannot be somebody who is considered to be disqualified. So you cannot lend money from your IRA to yourself, spouse, kids or grandkids, and other close family members. So when we're talking about private lending, all of these different options are available to you as long as your borrower is not considered to be a disqualified person. When it comes to the terms of the loan, I think this is what's attractive to individuals who seek private lending as an investment, again, inside an IRA or not, because when you're lending your money to another party, you're getting to sit in that same seat that the bank does to determine what the terms of that loan may be. How much am I going to loan? What's the interest rate that I'm going to charge? When does this loan going to mature and pay me back? And if you're doing this within your IRA, you're almost setting the rate at which your IRA is growing, so long as you're receiving those direct payments every month or every quarter. Another benefit of being a private lender is owning real estate is in an IRA account. It could expose you potentially your IRA to some liability, but simply being the private lender, no one sues a bank if somebody trips and falls on the property. They're going to sue the actual owner of the property themselves, and it can certainly be a lower maintenance asset, simply receiving payments back, as I mentioned, each month, as opposed to owning real estate where you're being in charge of and tracking your tenants, maintenance items, things of that nature as well. We did have a question come up, which is a great question. I think maybe our borrower or our guest presenter might be able to answer this better as well. It says you said you can lend to homeowners from your self-directed IRA. Don't you have to be licensed to do consumer loans? Self-directed IRA can't be licensed. That is correct. And I know that many of our clients who are lending to homeowners may be using their IRA through a mortgage broker who is making sure that they're licensed and making sure that they're doing the proper loan. But before I have my guest presenter come in and chime in on that question, I did want to introduce and bring in Doug Smith of Castle Rock Capital Funding. Doug, it's been a while since he's been on with us in the past, but great speaker, very knowledgeable individual on the arena of private lending, and going to really talk about today properly underwriting a loan. Doug, how you doing today?
I'm fantastic, thank you. And it was a good question out of the gate. So
absolutely, yeah. I was going to say, yeah. If you want to,
I wrote it down, and I'll cover it. I'll cover it in just a moment here. Actually, you know what? Why don't I hit it right now before I even go through the rigmarole of the introduction? So, licensing. The answer is yes, but if you are only doing one or two of these, most states will allow you to do a certain amount. I think, for instance, I know that Advanta's got offices in the state of Georgia. I think it's below 5. You can get away with just doing a deal for someone you know. But you're right. We carry the licensing to do this type of lending as well. So to go out and show that I had experience, show that I had liquidity, show that we were a stable company, had the ability to be able to service and take care of a loan, and of course go out and pass the licensing exams. Which, if you notice at the very bottom, this is our company's NMLS number, which is the licensing entity for lenders, particularly mortgage type lenders. So the answer is yes, you do have to have a license if you were going to do it as a business. And do several of them. But if you're just going to do one or two, then most states will allow you to get away with that.
Thanks for answering that question. But yeah, I mean, if you want to jump in, like I said, introduce yourself. Well, you and I have known each other for several years now. So, and I know you've worked with people who've had IRAs and done private lending. So I'm happy to have you back.
Yeah, we have a lot of them now, actually. And I will tell you this: I just because I'm sitting in front of Scott, this is not I guess a false type of statement here, but I'll tell you the people at Advanta are fantastic to work with. Alex, Larissa, and particularly Scott. I know with his legal background, I will ask him questions periodically. We had coffee not too long ago, and we were talking about a particular trend that's a little bit concerning that I'm seeing. Some of these subject twos that are out there. There are a lot of things that the gurus don't tell you, and Scott and I think we're in lockstep as far as what we felt. But it's awfully nice to have somebody with Scott's background that knows the legal aspects of dealing with lending or buying investments in an IRA. And I will tell you, I know of no one else out there. Scott would be my first call if I had a question. I speak at a lot of national conferences. I know a lot of people across the country. I've done this for 32 years. Started with Norwest Banks for the first 4.5 years of my career in the Midwest, Missouri and Illinois. Went on board with Bank One, their mortgage division. I was in their home office, and then they moved me to Florida in 1996 to run that for this area, the mortgage piece. So that was a long time ago. And then I jumped into banking in the very late 90s, particularly with First Union / Wachovia was with them for years, started their segment of their private client group in the west coast of Florida, ended up in commercial lending, so doing retail centers, hotels, widget manufacturers, and whatnot. So I actually do have a formal credit background with two of the largest banks in the world. As the thing says here, tens of thousands of loans that I've underwritten in the past. And currently, before the last crash, I think it was 2005, we really said, gee, this train is coming. That's going to we're going to see a big crash led by real estate lending. And how do we as bankers, I would say, survive that? So that's why Castle Rock was actually born. Myself and a couple of other folks created it. They have ridden off into the sunset. As you'll notice, my white beard, I've done it a long time here. But what we really do is we're primarily a lender / broker of real estate backed loans. We also do some fund and bank consulting on mortgage and note lending and purchasing. We do also work with, I don't know if there's private lenders on here, we work with people like yourselves. If it's a loan that is lower than what we normally do as far as size wise, we'll actually broker, basically sell that loan, do the underwriting on it, run that by you, and that person, I should say, and they'll purchase the loan for their own portfolio. And we also we do contract underwriting as well for smaller, mostly private individuals that are trying to build a portfolio but just don't have the ability to be able, or the experience for that matter, to properly underwrite a loan, pull credit, things like that. And we'll talk a little bit about that. But I will mention at the bottom here, that is my personal cell number, the 813 number that's showing there. That is also my email address to me directly. So if anyone has a question, I am more than happy to take a call or a text or an email, and I'll do my very best to answer that. I don't know everything. Scott certainly does know everything, but I don't. But I'll certainly try to get the answer for you, and I'm happy to do it. And this slide will appear later as we're answering questions. So if you don't get it now, then you can always nab it later. So why don't we just jump back into some of the things that we do? And I thought the easiest way to go through this topic was to talk about the proverbial 3 C's of credit: character, capacity, and collateral. And really our job as an underwriter, and your job if you're trying to protect your portfolio, is simply to mitigate the downside risk to the investment that you're making. It is awfully easy to say, gee, I'm going to give money to this person because they're a good guy. But in reality, it has to be a very dispassionate and analytical decision that you're making. You've worked so hard for your money your entire life, and you certainly don't want to put it at undue risk. And that's what this entire discussion today is going to be about. And before we move to the next slide, I kind of want to talk about what we're going to focus on today. We only have a limited amount of time here, so I'm really going to focus primarily on real estate lending and also private lending, which is why our audience is here today. I'll tell you, some of the things that I'm seeing on Facebook groups of private lenders really alarm me. As you saw the gray beard earlier, I've been around the block. I've seen a lot of ups and downs to the economy. I've seen a lot of ups and downs to lending. And what I'm starting to see some lenders do, not looking at income documentation, looking solely at collateral. But more importantly, a lot of people are now saying, I provide 100% financing. You don't have to put any skin in the game whatsoever. That is usually a very good indication that we're going to start to see some loans fail at some point. So, that's underwriting 101. The borrower needs to have some skin in the game. So I'm starting to see some very alarming things from private lenders that does really indicate that either A, they're not getting good advice, or B, they don't have experience and they're trying to do it on their own. So I'm going to tell you a story real quick about when I first started out. I was at this bank in St. Louis, and a pastor walked in the door. Very nice man, well dressed, spoke eloquently, and he was a pastor at a local church, and so a pillar of the community. He wanted to borrow some money. So he sat down with me. Of course, back in the day, keep in mind, we didn't have the internet. We did have did have the ability to pull credit reports right there, but we did not have the internet yet. We still had the old black CRTs screens. And so I took his loan application and pulled his credit report. Unbeknownst, he gave me permission, but he didn't know that I had it in front of me. And I was shocked to see that he never paid a bill he'd ever had in his life. And I was a little taken aback by that. I'd only been on the job less than 30 days at this point. I was fresh out of college. So I excused myself. I went back into the officer's, the branch manager's office and told him the scenario. And his response to me was, well, what's the problem? Just decline the loan. And my response was, well, he's a pastor. He's a pillar of the community. I don't understand. And it taught me a very valuable lesson that people will stand in front of you and say, I want to borrow money, and they will look the part, they will sound the part. You might really think that they're the pillar of the community that's going to pay you back, but there are certain things that you really need to do to protect yourself, because what you see in front of you may not necessarily be the case. So forgive me for droning on about that, but I wanted to at least illustrate that looks can very well be deceiving, and that's what we're going to talk about today. So Scott, can we go to the next screen, please? Hey, there we are. Okay. So I'm going to go through these relatively quickly. We're going to start with the 3C, which is character. Some people call it credit, and it's kind of the same thing. The idea is past predicts the future. So if you're, actually, I think we jumped back there, Scott. Did you see that? It's okay.
Doug, is it showing it should be showing the 3Cs of credit. It's showing the 3Cs of credit on my end right now. Hopefully that's what you're seeing. If anyone's
that was what I was seeing. I'm ready to go to the character part. There we go.
Gotcha. Okay, my bad. Sorry. Thanks.
No, it's all good. So not that you're going to pick up anything on this, but past predicts future. So what a borrower has done in the past is really going to predict what they've done in the future. And this is one of the biggest issues that I see happening with private lenders is they go off of what they think the person, the person is, and not what they really are. And there's two different, I didn't know how to read. We didn't use credit scores for the first 4.5 years of my career. Now everybody is so credit score dependent. What's your credit score? What I was really looking for when I look at a credit report is more or less trends. And what I mean by that is bad things do happen to good people, and they could be going along paying their bills for years, and then all of a sudden run into a problem, maybe an illness, an accident, something happens, a job loss that causes them to start to slip a little bit. And what I'm really looking for there when we check credit is how did they recover from that? Have they recovered from it? And if they have, you'll see a lot of people that go along, they have a dip, and then they recover, and then they're back humming along like they normally would. That does show a great deal of character. The person didn't give up, they fought through it, and if they're willing to do it back then, they're probably going to do it with your loan. So if you make a loan to them and you see that kind of pattern there, that kind of speaks to the character of the individual. Now, conversely, we see most bad credit situations as a yo-yo, to where it's a constant battle over the years. They're up, they're down, they're up, they're down, they're up, they're down. And those individuals, honestly, from what I've seen in my 32 years, will usually never recover. They're usually the type of person that is, if you make them the loan, they are very much likely going to default on you because they've shown it time in and time out. So I'm not going to spend a lot of time on character, but it's something that most people absolutely ignore. So Scott, can we maybe flip over and talk about the next page, which is capacity?
Yeah, sure, Doug. Yeah, actually, quick questions. I'm just curious, on the character side, how much have you seen over the last couple of years as we kind of, I hate to keep bringing up COVID, but obviously it was a worldwide major life-changing event, for everyone. I think just how much is that play into, was that those things like is that what you're talking about, the character aspect of it, where people struggled during, a year or so time or 2 years, and now they're, economy's back going well, going strong again. Is that kind of what you're talking about in that regard, or is there other aspects just beyond job losses or changes there?
Well, it could be a myriad of reasons that they run into problems, and it could be an illness like COVID. It could be a job loss that was caused by, the pandemic and the shutdowns that were going along with it. But really, it's we run in cycles, and you've seen ups, you've seen downs. We had a mini crash not too long ago. We had a big crash back in '07 and '08, the biggest that we've ever recorded since they've started tracking housing prices actually happened in that crash. That was the biggest single drop that we've ever seen. But we recovered, and if you'd have just held on to your assets for a few years, 6 years to be exact, you'd been up money. And it's just like that with credit. If somebody is just humming along and they run into something like COVID, though, and they recover from it, which they normally will, unless of course they really got sick, then they start humming along again. I haven't seen as many as you might think fall prey to it. Maybe a lot of that has to do with PPP loans, the EIDL loans that the SBA was making. They were incenting businesses to keep people employed. That could be it. But I really didn't see as big of a slip during COVID as one might think. Believe it or not.
Yeah. Just curious, how much that's gone into, the last couple of years. That's been a bigger factor than has been in the past. But I guess that maybe not necessarily. I guess so.
Well, let me tell you what I think has been the biggest factor that COVID has caused, and you could also throw in there, Afghanistan and Iraq wars, things like that, is the amount of government spending. If you go to the St. Louis Fed, they have a chart of the currency that's in circulation, and it's quite alarming. Where really kind of beginning in the first Gulf War, our government started to spend a lot more money than they were taking in, a lot more than usual, I should say. And so they were printing money. But since the pandemic started, the amount of money that's in circulation is dramatically increased. So when you see the Federal Reserve continue to raise rates to slow the hot economy and control inflation, this is of course an opinion. I think inflation is being caused more by the amount of money in circulation devaluing currency. So the amount of your dollar, because there's so much out there right now that the government has spent so much that it's devalued the currency, and that's why you're seeing a gallon of milk cost so much more, and other goods, more than just a hot economy. So the raising of interest rates is probably going to be, to my opinion, a little bit counterproductive, and I pray that they kind of stop soon, because it's just it's getting too hard for normal people to save money and to buy a house and do things like that. So sorry to go off on a tangent there, guys.
That's okay.
But as far as COVID, that's the bigger impact, I think, than credit. I haven't seen a big negative impact to credit, and I would have expected that with COVID, believe it or not. So, but it was a great question. What I'm also going to talk about here is capacity, which is there's a guy that I used to work with when I first started my career. He's probably long since retired, a guy named John Sondrecker out of the Midwest. And John used to say that the three most important things in lending were ability, ability, and ability. Meaning, does the person have the ability to pay the loan back? And that's really capacity. So to me, the most important of the three C's is, what is your exit strategy? What is the borrower's ability to pay you back? So many people get focused on the one we're going to see in a minute, which is collateral. They say, gee, I'm well collateralized, that they really don't think, does this person, can they afford the loan? Can they actually pay me back? And it's more than just income. It's also the stability of income. Do they not only have enough income, but how stable is that income? Is it seasonal? Is it something to where they're going to get laid off quickly? Or is it I'm going to give you a good example. A bank I used to work with did a study on the best and worst paying profiles, meaning when you would take a loan application, you'd have to put in a code, a job code, whether you work for an IRA company or you're a airline pilot or a police officer, whatever, there'd be a code that went with it. The number one best paying profile of all people was a registered nurse. Okay. So, and the biggest reason for that is not only that it's a good job, but it's very stable. You really have to screw up to lose your job in nursing. If you lose your job in nursing, you're going to find one somewhere else. and that makes sense because it's a very, very stable job. You're always going to have income coming in. If you're just going to work and doing your job every day, you don't have to worry too much about layoffs in that role. But also assets. What kind of we always ask for bank statements. I want to see the last couple of months worth of bank statements, brokerage statements. I want to see what the person has out there to fall back on. So that if for some reason they're unable to make their payments, are they able to go get money to actually make the payments on the loans that we underwrite? So it's a really big deal. And I would say honestly, going along with that is really dovetailing with the experience of the actual underwriter or the lender. You have the ability to kind of see, hey, 2 years ago I had a similar situation, didn't go very well, and a lot of that has to do with the capacity of the individual and understanding. So, but I do want to kind of flip over real quickly, and I'm very mindful of our time today. I want to talk about collateral, and this I think is probably the most overused or over-leaned upon aspect of the 3Cs. It seems like private lenders just want to worry about, do I have enough collateral? But what they fail to remember, and we're going to talk about it on the next slide, is that you got to get the collateral back. The collateral is actually owned by the borrower, and you might have to go to court to get it back. And on the next slide, we're going to talk about it. But what we're really doing when we underwrite a loan is we're looking at primary, secondary, and tertiary forms of repayment. And what I mean by that is, how do I think, what's the exit strategy here? What's the great escape? I've got Houdini on here, but what is the first way that Houdini is going to get out of these chains? It usually is the income that's coming in from their job, or maybe it's the rent on a property. That might be the primary way that we're going to get paid back. But what is the secondary? Is there a backup to that? And that's very important to realize, because what happens if COVID hits and the primary income goes away? Well, they have all these other properties to fall back on. They have a lot of equity in their home that they could go get an equity line. They have several things that they could possibly do to be able to take me out. And then finally, the tertiary, which is the third or the last resort, so to speak, is actually foreclosing on the property, which kind of takes me into the next slide. And I know that we have people on here from all over the country, and I did want to cover the different ways that that foreclosures and perfecting the lien is going to occur. Perfecting a lien simply means making sure that security interest is filed and that you'll be able to exercise against the collateral should things go south on you. Now, I'm in Florida, and Florida is what's called a lien theory state, as opposed to a deed theory. Now, in a lien theory state, you sign a mortgage. When I go out and get a mortgage loan, let's say, the mortgage really is the security instrument. It's what creates the collateral. It's the form that the borrower signs that I go file at the courthouse that says I actually have a lien against the property, or I have a claim against that property should they not pay the promissory note that they're signing. So the mortgage, in a lien theory state, you sign a mortgage. The borrower retains title to the property. I just have a lien against it. Now, if I want to foreclose on it, I have to go to a judge. I got to get a court date. I got to hire an attorney, draw up the foreclosure paperwork. I have to go through the entire process to be able to get that back. Depending upon the state and how busy they are, that could be a quick process, or it could be one that would take 2 to 3 years, particularly if that borrower decides to hire an attorney and throw legal defenses at us and kick the can down the road. Hey, can I have a continuance, judge? Sure, let's get together in 6 months. So it really could push that down the road, and this is one of the reasons that I think people lean on collateral too much. And particularly if they're saying, I will do 100% financing, they're not taking into account what might happen if things do go bad. Listen, everybody still gets married, but nearly half of all marriages in this country end in divorce. Does anyone actually get married thinking they're going to end in divorce? Probably not. So when you make a loan, it's the same thing. You think the person's going to pay you back, but you want to plan for what happens if they don't. And making a 100% loan to value loan, say the property's worth 100,000, I'm going to give you 100, is a sure way. At some point, it's going to bite you in the tail. It really will. You want to make sure that you're leaving enough equity in the property should you have to go through foreclosure, to be able to pay your attorney, to be able to really recoup the interest that you're counting on to grow your retirement plan. Because, let's say you go in and you're charging 10% interest to a customer, and then all of a sudden they don't start paying you. You do have the right to be able to recoup that, but how are you going to get it back? By selling the property. If you're already at 100%, there's nowhere to go. But if you're at 80%, let's say, or 75 or even 85, then you do have a little bit of equity to when you get the judgment, you can include your legal fees, your interest that was due to you, etc. Okay. Deed theory states are a little different. And I know that Advanta has an office in Georgia, but Alabama, North Carolina, Tennessee, all surrounding states that are also deed theory. You don't sign a mortgage in a deed theory state, you sign a deed of trust. So you're really basically, for all intents and purposes, you're signing the property over to the bank's attorney or the lender's attorney to be held in trust until which time the loan is paid off. Now, of course, the borrower still has to pay the taxes and insurance. But here's what happens in a deed theory state. That usually moves, you don't need a judge in most states for that, unless they decide to countersue and fight. What you do is you simply have your attorney go through the process that's laid out in the loan paperwork, give them time to cure the defaults, pay it off, whatever. But then the attorney basically goes on either the courthouse steps or the steps of their office after publishing, hey, 30 days from now, we're going to sell this property to get our money back. It really speeds through the process. And that can be done in as little as 90 or 120 days, where in a state like Florida might be 18 months to get your property back. So you have to be mindful of that. So make sure that you're perfecting your security interest. And a lot of people don't look into that. Why don't we go to the next slide real quick, Scott? I'm looking at the clock, and we've got probably about 8 minutes or so to still chat before questions. I want to talk about the word no. One of the reasons that we get hired by private lenders to do due diligence, even though they know they don't want to make the loan, they might have a cousin or a good friend that's coming to them. Now, Scott, you can correct me if I'm wrong, but if the family relationship is too close, you can't lend the money out of your IRA. Is that correct?
That's correct. Yeah. So if for an IRA account, for you as the IRA owner, the disqualified persons who you cannot lend to include yourself, your spouse, your parents and grandparents, your kids and grandkids, and any business or entity that those individuals may control or own. So, but cousins, brothers, and sisters technically are not disqualified persons. In fact, I'll take just a second. One of the questions we had came in said, can I use my SD IRA, my self-directed IRA, to fund new construction on land that I own? And so the answer to that question is you certainly cannot lend money, as we're talking with this, what Doug just asked me, you cannot lend money from your IRA to you personally. Now, I would encourage that person to call me after the seminar. There may be a way of structuring it if you get some legal advice and some assistance on it, but it wouldn't be done by a private loan, because as you just asked, Doug, you cannot lend money from your IRA to those family members that I mentioned. But again, brothers and sisters, cousins, close friends, those are all are permissible as long as the terms of the deal are fair market value and kind of what you would do with any other person.
Yeah, and I'll go back to that point in just a second, but to kind of add to the question, I think I'd have a little bit of concern about it, and it's really not worth busting your IRA if you already own the land and it's in your personal name. I'm not sure that improving that land wouldn't be considered by the IRS to be giving you self-benefit, so to speak. So listen, someone used to say you can't get a little bit pregnant, either you are or you're not, and I would really be hesitant to be able to do that. I would think it might bust your IRA, and if there's a risk, I wouldn't do it. I mean, we do loans all the time to people that are building spec real estate on land they already own outside of the IRA. So something like that might be a better option. I'll leave it at that. But going back to no is the answer. Some of the reasons that we're brought in on deals might be, a distant cousin, a friend, a coworker comes to you. They know you lend money, and they say, "Gee, I really would like to borrow money," and you don't want to do it. It's really making Thanksgiving awkward if you tell cousin Joe, that you're not going to give them money because you just don't like them. Believe it or not, a lot of the people that come to us and say, hey, I want you to underwrite the loan, they'll wink at us and say, but I want to find a way out of it. And they say, Doug made the decision. I have nothing to do with it. Yeah, I'm sorry. I'd give you the money if it was up to me, but Doug said no. We have that happen a lot, believe it or not. But it is so hard for private lenders to say no, particularly when they're shaking the person's hand. They're, walking across the property. They're seeing the need in the borrower. And if you're lending out your private money, remember you worked hard your entire life for this money. This is what really is going to go to support you and your family in your retirement. And you really got to mitigate that risk. And even though you may in your heart feel, gee, this might not be a loan that I want to do, they're tugging at the heartstrings, and it's really hard for folks to say no. Believe it or not, that might be the number one mistake that I see private lenders make, is they lack the ability sometimes to say no. And believe it or not, that's why, Scott, a lot of people come to us and say, hey, can you underwrite this loan for us? But we really don't want to make it. And here's why. And I usually agree with them, by the way. But it's just to make Thanksgiving a little less awkward, believe it or not. So you got to be able to thicken your skin a little bit and be able to say no when you're lending your own money out. Could we jump to the next one here, Scott? Is that okay? All right. So the final screen, I wanted to leave plenty of time. I went short by about 3 minutes here. I wanted to stop at 12:45 to answer any questions that are coming in. But I'm going to tell two stories before we get into that. These are things that actually happened in my career, and they illustrate sometimes where somebody that is maybe doesn't have my longtime background in lending will make a serious mistake. So the first one, I left Wachovia before we started this company and was working for a community bank that was actually in trouble. And I was trying to help them work out a lot of their non-performing assets. This was right when things started to turn south with the last crash. So we had board members. Now, believe it or not, most of the board members of banks don't have banking backgrounds. You might have one or possibly two on the board. Most of them are local business people that the bank brings on board to try to refer more business, refer more of their buddies. So they put them on the board. So I had a board member come to me, and he referred a lot of business to me, and it was a commercial lender at the time. He said, hey, I've got a friend of mine with a business, and he wants to borrow $1.2 million for this business, and I'd like you to give it to him. So sure, we'll chat with him. I took the application, I pulled credit, I looked at his financials, and there was no way I was going to sign off on that loan. It was a bad loan. And the reason that I thought this was really a myriad of reasons, but the answer I got back from the board member, but he's such a good guy. That's the reason he wanted to make that loan, was he was a good guy. But everything in my being told me not to make the loan, and I had a lot of scientific backing for that, and I declined the loan, which enraged the board member at me. He took it to the chief credit officer and the president of the bank, who looked at my work and backed me and said, yeah, Doug's right on this. We're not going to make this loan. So he reached into his own pocket, and he was a very wealthy individual, and gave his friend $1.2 million for his business. And within just a few months, he'd lost the entire thing. So that money was gone. He lost $1.2 million making a loan that he knew darn well he's been told by professionals shouldn't be made. And unfortunately, he made that loan, and he'll never see that money again. Another one was a mistake that I saw a private lender do. They came to me and asked, gee, how do we get out of this? And unfortunately, there wasn't much of an answer. I don't know how many of you have heard of a real estate investment, something called the FEMA 50% rule. What the FEMA 50% rule says is that if you are buying a property to renovate it, say a flip, and maybe just a dilapidated home, and if that property sits in a flood zone, FEMA will only allow you to repair the property or to renovate it up to 50% of the structure's value, not the value of the property, including the dirt, just of the structure. And I know I'm in Tampa, which is Hillsborough County. And I think Pinellas is the same way, but they look at your tax assessed value of the structure, which is, you probably look at yours, probably isn't that high. So you can only fix up the property 50% of that way. Now, I had a client that had decided to make the loan without asking any advice from anybody else, and they didn't know about the 50% rule. And what happened was the investor bought the property and then couldn't renovate it because of the law. They couldn't put enough money into it, and they ended up taking a big loss. Not only the investor lost a lot of money when they sold it, but so did the private lender. So there's a lot of little hidden things that you don't know what you don't know, and sometimes those things that you don't know will hang you. So I know we've covered quite a bit. I didn't have a lot of time to really get into 32 years of background in 45 minutes, but Scott, do we have questions out there or anything that you wanted to kind of cover while we were here
Yeah,
that I didn't get
yeah,
to?
we did. Yeah, we had a couple questions come in, so we'll start with those. And again, I would encourage anyone that's listening live here to get your questions typed into the box here. We'll try to get to those in the time we have left. Someone had asked, do you write into your notes collecting on rental income if the note is in default?
Yes, yes. That's an assignment of rents and leases. It's actually a separate document that is typically signed when you're signing a mortgage note that allows you to actually go directly to the tenant and start collecting the rent if the note is in default. Absolutely. Assignment of rents and leases is what that document is called, and that's a standard part of an investor deal.
Great. Next one. What are your thoughts or experiences with home equity agreements or home equity investments?
Perhaps and we can clarify that. Are we talking about home equity loans or second mortgages, so to speak?
Well, someone
Uh,
said they actually there were option contracts for the future value of the home. If that helps answer it, that was the other part of what they added in.
an option
Um,
contract for the future value of the home. I'm big on
yeah.
what's it worth today. Now there's an exception to that, and that would be a construction type of loan. So let's say that let's go back to the earlier question. Let's say we're not even talking about dealing to yourself or self-dealing. Let's say that you've got that the person that asked the question is actually going to another IRA owner asking for the money from them. Hey, I've got this property. I want to build on that property. The property is worth $50,000. I'm going to put $100,000 into it for a total cost of 150, and it's going to be worth 200 when I'm done with the property, and I'm going to sell it, flip it out. We do look at both what is going into the property, but also what the future value of the home will be. I'll count typically for the first 6 months. Sometimes a year. It just depends on the situation. I'll use what the cost was. So if you went out and bought a property yesterday for 30 grand and came to me and said it's worth 100, I'm going to count it as 30 as far as the value. I'm not going to give credit for the 100 if that's the question. Now down the road, let's say you've sat on that for a while, a couple years, a year, whatever. Most lenders are 6 to 12 months as far as when they'll start to recognize that equity. But getting money back at the table and recognizing future value is not something that I'm comfortable with. And that actually is something that I don't know of any institutional investors or lenders that will do. That answer the question, maybe? And if not, please.
I think so. Yeah. Yeah. If not, yeah, reach out to Doug directly with his either his email or his phone number here on this screen. I think getting back to you talking about kind of lien states versus deed states. Someone asked, it kind of probably brought this question up. Is it possible to require the title in lieu of foreclosure to get the property back if somebody doesn't pay? Is that something that you are able to write into your documents or require that you just simply, deed in lieu of, as opposed to going through a foreclosure process?
I don't believe so. I don't believe that's the case. That would be something for a real estate attorney, but I've never seen it done. I would think that it would have some legal issues with that, because if you think about it, inside of your note says, listen, you have the right to foreclose against the property already. The deed in lieu really, particularly in a lien theory state, I still think you'd have to go in front of a judge. So I don't think it would have any effect. But that would be a question for an actual real estate attorney. When I say real estate, I'm talking about creditor rights, somebody that actually is a collection attorney. I can refer you to a couple of good ones, depending upon your area. I may or may not know them, but I I don't know the answer 100%, but I don't think that would be something you could do.
Yeah, 'cause I don't know that you could require it. I know that we have certainly seen some clients over the years, a few here and there, that have received a deed in lieu of foreclosure as a way to kind of uh, avoid the foreclosure process, depending on how long and drawn out it is. But yeah, I would agree with Doug in this situation. If you're going to do a deed in lieu, you definitely want to have a real estate attorney advising you and looking into any potential issues, at least making you aware of any potential issues you might have by accepting that deed in lieu of the foreclosure, and making sure if you do that, you are taking all the proper legal steps to protect yourself. The last thing you want to do is try to shortcut the system a little bit and have it come back and bite you at the end. So definitely get advice in that circumstance.
And
Um,
I will
yep.
add this. I've done a ton of, and Scott knows this. I've done a lot of deed in lieu of foreclosures. Actually, when we first started our company, just as much as we were lenders, we were actually buying bad loans out of banks, and then we started working with larger hedge funds that were buying big tranches, which is a big pool of loans, and we would take over. We called it the tail end of the tranche, meaning the worst paying, and we would buy them at just a significant discount from what the underlying collateral is worth. And a huge percentage of those we were able to get back with a deed in lieu of foreclosure, because at some point the property owner. Now I will tell you this: I've never thrown Granny out on the street, but when we were buying those loans, we would usually they were on properties that were abandoned, customer walked away from, or investment. And that way we were actually able to go to the borrower, and at that point they're usually upside down. They're in disrepair. The customer is not in it. If they haven't been making their payments, there's a reason why. They probably can't afford to. So I have found that most borrowers are very receptive to a deed in lieu of foreclosure if you guarantee them that you're not going to A, ruin their credit report by doing a foreclosure, and B, you're not going to chase them for the deficiency balance. Whatever is left over at the end. You just want the property so you can stabilize it, liquidate it, and try to get as much of your money back as you can.
Next question, Doug, says, what about the move where you can't use credit scores? I'm seeing that as a limitation in screening tenants in Colorado. Are you seeing that in loans?
I won't do the loan.
Yep.
Listen, there's a lot of here. Let's go back to marriage. There's a lot of fish in the sea. If I can't, and by the way, I rarely use credit scores myself unless we're brokering the loan, and I'm more looking at patterns in the credit report. If I can get those patterns, then I'll do the loan. If I can't see the patterns, listen. If I handed you a jar of jelly beans, and there were 10 jelly beans in there, and I told you one of them's poisoned, would you reach in and take that jelly bean? I want to know what the payment history of that customer is, and if there's some kind of prohibition against me knowing what kind of credit history that person does, I'll live to fight another day. Most of you, even ones with sizable IRAs, really can't afford to take a hit, and I'd walk from that loan. That's my take.
Right, maybe we'll, I guess I have one more question I'm going to leave for the last question that came in, but just a question of my own, I guess. What do you think is, I guess, Doug, you focus obviously on things to be careful of doing. What do you think is something that private lenders do very well? Obviously, maybe something that where maybe two different things. One thing where you think private lenders struggle a lot with, that they need the assistance of a different professional with, and also maybe things that they do really well as a private lender, that's something that's something that they have more control over, or to utilize their capabilities and what they're best at.
I would say two things. Number one, speed. If I take a loan application, Fannie Mae or whatever, I'm going to give you an example right now that we're dealing with. We have a customer that I've worked with in the past, wealthy people. They're buying a $2.2 million condo. It's going to be the last place they live, and they're putting down 50%. So they're looking for a $1.1 million loan. Everything on that loan, credit, income, assets, everything is perfect on the loan, except that the building is not yet complete. So they don't expect for another 4 months that that everything's been sold, they're just releasing them floor by floor, and they still have probably 3 or 4 months left before everything's completely released. That being said, no Fannie Mae lender will touch that loan because the building has not been completed, even though this is a perfect person. Now, obviously, 1.1 is a lot to put in your IRA, but it's an example of creativity, which is the number two thing that I would say. Your ability to be able to step in and see something that is absolutely nonsensical and bypass it. And we do that sometimes. We're underwriting for someone. There'll be a nonsensical thing that's being requested that the customer, for one reason or another, just simply can't provide. But the bureaucracy of underwriting and hedge funds that buy these things and securitize them require you have to have this in the file. A private lender can bypass that. So the creativity is huge, plus just the speed at which it happens. Some of these hedge funds that are backing the loans and the tranches, Fannie Mae, whatnot, are very slow to move. And if a customer needs to move quickly, transactional funding is a great example. You mentioned earlier, Scott, one of your slides. That has to be done very, very fast. The ability to be able to take down a distressed property from a fix and flipper, that's got to be done with greasy fast speed. You can't wait for a bank to underwrite it. So I would say those two things are probably the big bonuses that a private lender has over an institutional lender.
Right. So last two questions here. One person asked, do you have a pool of borrowers that you match with lenders? I don't know if you have, that's something people can work with. And this is kind of goes hand in hand, I guess, a little bit with the last question, which would, kind of what would be the process to use you to help underwrite a loan? And can you do that in all 50 states, kind of where you licensed to do that with? But maybe kind of address both of those questions and then we'll wrap things up.
Yeah, I will tell you, it depends on the type of loan that's being done. I can contract underwrite pretty much everywhere as long as I'm not making that loan. I do not like to work, and I'm not knocking New York. I don't like to work there just because of the laws. It is an absolute nightmare for lenders and landlords there sometimes. I'm not a fan of New York. No offense to the people that are on here. It's a wonderful state, wonderful place, but the laws are just not conducive to being a lender there. But we can go all over. If it's a consumer loan that we're doing, meaning it's an individual that's buying a place to live in or a second home, then we do stick to Florida. I can underwrite anywhere, but if I'm going to make the loan and then turn around and broker it or sell it, that's got to be in Florida. If it's for a real estate investor, I can go all over the country. So the process by which we do that, do we have a pool of people? And we have regular customers, particularly real estate investors that come to us and they've got some experience and, hey, I want to buy 123 Main Street. Can you help me out with that? Then as long as I really understand the appetites of the individual that are out there, and I would encourage you to reach out and let me know what you're looking for. And if we see it, we'll certainly run it past you. That I'd be happy to do that. Love to. And my number's right there. Email's right there on the screen. But as far as how would you do it, I would say let's start with a phone call, get to know one another and talk about the process. We actually have an online link that we send the customer, and depending upon the type of loan, I hate to say we've got these templates that we've set up that are really cut and paste that say, gee, if this is a fix and flip loan of this type, then we kind of send this set of documents that we require, and I'll tweak that depending upon the situation. But we have this link that we have them go on and complete the application. It also gives them through that, they give us the authority to be able to pull a credit report on them. And it also provides us with a secured portal by which they don't have to email documents in an unsecure manner. They create a password when they first start the process on this link. And any emails that we send them down the road with required documents, say we need bank statements or we need a survey on this property or whatever, they can actually use that password to securely upload it right into their own customer portal. So that's really what we do, but it really starts with a phone call and to understand what your needs are. And if we've got a fit, then certainly we'd love to work with you.
All right, Doug, again, thank you very much for your time. It's great information today, and obviously you have your information here up on the slide. Anyone wants to have a further conversation with Doug, maybe ask something they didn't want to bring to the forefront of the live webinar, or certainly anyone who's listening to the recorded version of this webinar, reach out to Doug to get your questions answered. Again, you're happy to reach out to me if you have any questions on self-directed IRAs. Certainly can reach my contact information here on this last slide. Again, Doug, thank you again very much for your time and sharing your expertise with us today.
Anytime. I love working with you guys. You guys are so great. And I will tell you this about Scott and his team. If I have a question about IRAs and whether something is kosher or not, Scott's the first person I would call. And you guys are awesome, and I'm so pleased to help in any way I can.
Well, I appreciate that, Doug. That is not why we brought you on today for that endorsement, but we certainly appreciate it. But yeah, great information today, and we'll definitely look back to have you back on again sometime soon.
Thanks so much. Enjoyed chatting.
All right, like always, thank you, and thanks everybody for attending. We'll look forward to having you on our next event.